You're listening to Simply Put, a podcast from FHN Financial. I'm your host, Will Comperl. After high first quarter inflation postponed the beginning of Fed easing this year, a cooling labor market and sufficient inflation improvement gave the Fed permission to start cutting rates in September. Now that the Fed funds rate has fallen 100 basis points from its peak this cycle, Fed officials and market participants are heading into 2025 unsure where neutral policy will be, whether the economy can stay resilient, and how new federal policies will change the path of rates and the economy. On today's episode, we talk with FHN Financial's chief economist Chris Lowe and senior economist Sophia Kearney-Lederman about the biggest economic stories of 2024, what surprised us the most this year, and what we've got our eyes on for the year ahead. Stay tuned. Coming up soon, our discussion with Chris Lowe and Sophia Kearney-Lederman. But first, a quick market update. The Fed cut interest rates 25 basis points last week, as expected. The latest dot plot suggests Fed officials have become much less optimistic about future rate cuts since the September meeting. Cleveland Fed President Beth Hammack even dissented at the meeting, noting a preference to keep rates unchanged. As always, future Fed policy will depend on the data and be decided meeting by meeting, but for right now, the widely held expectation is for rates to stay unchanged at the January 29th meeting. Past that, new federal policies and their impact on the economy provide an elevated source of uncertainty moving forward in 2025. November retail spending came in mostly as expected last week, underscoring estimates for fourth quarter economic growth to remain solidly above 2%. With December data not yet released, the Atlanta Fed's GDP Now model is tracking 3.1% quarterly annualized growth. November PCE inflation came in lower than expected, a welcome surprise after a few months of uninspiring inflation data. The core PCE deflator rose only 0.1%, low enough to keep the year-on-year rate at 2.8%. The Fed prefers to look at PCE prices to gauge price pressures and, given some important methodological differences with the CPI, can behave differently month to month versus the CPI. The Treasury market sold off after the Fed meeting, pushing 10-year yields above 4.5% for the first time since May. TIPS yields and estimates of term premia had been rising before the Fed decision was announced, suggesting the upward climb in yields may be the market's gradual realization of policy uncertainty and higher long-term Fed funds, rather than surprises from the communication at the Fed meeting last week. The federal government just barely avoided the threat of a last-minute shutdown last week after Elon Musk and President-elect Trump announced their opposition to a bipartisan bill that would have kept the government funded early into the new year. It took a couple revisions before the House was able to finally pass the bill, though the lack of unity among Republicans could foreshadow some difficulties starting next year in fulfilling Trump's policy priorities when the GOP majority in the House is razor thin. That's all for the market update this time. Now our discussion with Chris Lowe and Sophia Kearney-Lederman. We have two guests returning to the podcast today for our second year in review episode. Chris Lowe, chief economist with FHN Financial. Chris, good to have you back.
Good to be back.
And Sophia Kearney-Lederman, senior economist with FHN Financial. Sophia, good to have you back.
Thanks for having me again, Will.
Now, we got the Fed easing in 2024 that seemed so certain at the end of last year, though I think waiting until September for the first rate cut was later than a lot of people expected at the beginning of this year. With yesterday's 25 basis point cut, the total easing in 2024 came to 100 basis points. But to put that into some context spanning the whole year, Fed funds futures had at one time priced in as much as 175 basis points of cuts in 2024 and as little as 25 basis points. The U.S. economy has still avoided a recession, and the labor market and inflation are, well, it depends on who you ask. But Republicans won control of the White House and Senate and maintained control of the House in November, and so they will be sworn in next year. But past that brief synopsis, I want to start this episode by revisiting the indicators we talked about in last year's year in review episode that we all thought would be important in 2024. So, Sophia, why don't you start us off? The indicator that you had shared with us that you thought would be important for this year was the math of renting versus owning. What is the status update there? And do you think it proved to be as significant in 2024 as you had predicted?
Wow, it's always great to revisit what you were thinking a year ago, and it's a great reminder. I'm glad that that's what I said and not something else. So kudos to myself a year ago. I think it's something coming around to the housing market that has played another really big role in 2024. It's been super important when we look at not only how people have felt about the economy this year, right? Will, you touched on just briefly in that summary how the economy's done pretty well this year, but people haven't necessarily felt that way. And a lot of that has come down to the math on housing, the lack of affordability for owning a home, and then the rent pressure that we've seen. And then it's also been a really big factor in inflation this year that's come down, but not necessarily as much as people would have expected and as much as the Fed would have expected. So I think it's still been a factor, pretty important for 2024. And I expect that it's going to be something that is still important in 2025 in large respect, because when we look at what the Fed's done, they've done rate cuts. But when we look at what's happened on the Treasury yield curve, particularly the long end, we've seen that rise, which has been the driver of the rise in the mortgage rate, the average 30-year mortgage rate this year. You haven't seen as much relief as you would have expected with Fed cuts. And with yesterday's Fed guidance of less cuts expected in 2025 and 2026, we're probably going to see that sort of pressure on the long end of the Treasury curve and mortgage rates remain in the coming year. So I think it's going to still be something in 2025 to think about.
I would add to that, when people talk about inflation being a problem, going into the election, for example, when it was still polling as a top 3 issue with voters, the conversation shifted over the course of last year. People weren't nearly as worried about food and energy prices. They were worried about the cost of shelter. They were worried about rents. They were worried about home ownership costs. So that has become such a big issue that now when Chair Powell testifies in front of Congress, he's peppered by questions about housing costs.
Chris, your indicator that you chose about a year ago for 2024, productivity. How did it end up? Do you think that it proved to be as important as you were expecting?
Oddly enough, it did. I say that because productivity at the beginning of last year, we thought, or end of last year rather, we thought was weak. The weakness in productivity was one of the reasons economists were convinced the economy was going to stall as soon as we ran out of pandemic savings. There was huge productivity growth found when the government updated the benchmark revision to the national income and product accounts, when they found, as a result of stronger productivity growth, a couple of trillion in income they hadn't realized had been earned in the prior 3 years. It's the reason the savings rate is higher. It's the reason GDP expectations are higher. It's one of the reasons that people have stopped perpetually worrying about recessions, which in turn is one of the reasons that interest rates are higher now than we expected they would be at the end of last year.
I'm going to have to go ahead and also take a victory lap on the indicator that I chose a year ago. So my indicator was the foreign-born labor force. And so if we put ourselves 12 months ago, the big issues of labor scarcity and the tight labor market were thought to be inflationary and going to be this answer to whether inflation can get down to 2% or not without the economy going into recession. And when you look at labor force trends between the native-born and the foreign-born, at the time, the increase in labor force participation since the beginning of the pandemic was almost entirely in the foreign-born labor force. But I think how this proved to be really important is in the spring of this year, the Congressional Budget Office published some research that helped answer these contradictions in economic data the last few years, and what they found was that the number of undocumented migrants that had come into the U.S. Over the last few years had been severely undercounted by millions. And I think this really seems to be the grand theory of everything at this moment that helps explain why the economy was able to grow above 3% for so long during Fed tightening, yet we still had an economy that wasn't overheated. And so, of course, with the new administration coming in next year, Chris, something that you've pointed out in your forecast write-up is immigration enforcement, and how those labor market dynamics play out will be a really important story for the coming year.
Absolutely. I don't think outside of the Fed, I don't think there's a broad understanding of how critical immigration was to the rise in the unemployment rate over the course of this year. Unemployment rate doesn't go up the way it did this year during economic expansions, or at least it never did in the past. This is a hugely unusual development, and it happened because so many people came into the country in the last 3 years, profoundly changing labor market dynamics.
Yeah, and it's one of the interesting pieces of that rise in the unemployment rate, because when the average person, I think, thinks of a rising unemployment rate, your gut is to think that it means more layoffs. It means big job cuts, right? That's what it means. More people are being laid off, and that's why the unemployment rate goes up. But as you guys just mentioned, it's been a totally different reason this cycle. And so it's been interesting to see sort of how the Fed and the market have both reacted to that rise in the unemployment rate, at times a little bit differently, right? You had some Fed officials almost call it, not when it rose to 4.3, but the good, quote unquote, type of unemployment rate rise.
For the next segment, I want to move to what was so popular with you guys last year, which is some 2024 macroeconomic trivia. And I say that a bit sarcastically because I know the questions proved to be pretty difficult. I still think that maybe, you can learn a little bit about things that have happened in the last 12 months. So I've just got 4 quick questions, and you guys can work together in order to kind of submit what you think is the right answer. So first, just as a throwback to the middle of July, what was the name of the cybersecurity company whose software caused significant IT disruptions worldwide that caused at least $6 billion worth of damage? You might remember that this software update made it so Treasury market trades could not clear, and it caused 1 trading session's worth of headaches across the world.
Was this the same one that caused flights to be delayed?
Yes, I think that's right.
Okay, wasn't it the CrowdStrike outage of this summer?
Yes.
Okay, I fell victim to it in travel, so that is why I can recall it.
Yeah, I know. I do remember a lot of people getting stranded for like 3 days in the middle of the country because when all of those flights, it might have been a few airlines specifically that had upgraded their software. And so if you were behind in the software updates, you actually weren't impacted. But CrowdStrike is the correct answer. A few weeks after that, what central bank's rate decision helped kick off a string of events that, in early August, caused Fed funds futures to price in a high likelihood of an emergency rate cut? I remember this. People were calling me, colleagues, customers, journalists, saying, is the Fed going to cut in the next 3 days? This was about the first week of August. So what was the central bank whose rate decision kicked off that process?
Hey, wasn't that the Bank of Canada, Sophia?
Or was it the Bank of Japan?
No, they wouldn't have cut, right? They hiked rates.
Oh, they went the wrong way, yeah.
Yeah,
Maybe,
they were coming up from negative.
I'll go with you, Chris.
I think because people thought the Bank of Canada wouldn't cut unless they knew the U.S. was cutting. Something like that.
I'll give you half credit. When I did say the question, I said rate decision, not rate cut. So actually the answer was Bank of Japan. It caused this
You nailed
unwinding,
it.
Oh,
an unwinding of the yen carry trade, which paired hours later with a really weak employment report in the U.S. And so equity markets sold off, and people thought this was signaling a recession. So I'll give you half credit because, if this question were written and you could refer to the text, I think you would have seen that I said rate decision rather than rate cut.
No, I think you've got to give that one to Sophia. I'll take the loss. So you take a
as a
plus
team,
one. I'll take a
50%.
minus one.
It's okay.
Okay.
I have to say, for the second year, I sometimes struggle to find interesting questions about treasury yields in the trivia sphere, but just as a kind of test of how much you remember the last 12 months, the 10-year treasury yield reached its peak April 25th at 4.70%, but in what month did it reach its 2024 low?
August. Maybe?
Yeah, I think you might be right about that. Because I do remember expectations for Fed rate cuts were extremely low in April. But by the summer, when that recession forecast was, at the forefront, it does make sense. Let's go with August and see what happens.
Pretty close. It was September. So it was a couple days before
Oh.
that September 18th Fed meeting. The 10-year got to 3.61%. And as I remember the narrative then, we had that string of 3 straight months of really weak job growth. So you have the 50 basis point rate cut, and a couple weeks later, September job growth was pretty high. And so that idea that there was an imminent recession coming was just totally priced out of the market. So close enough, but it was actually September.
Really good point you bring up, too, because that string of 3 successive really weak employment reports was mostly revised away in the next couple of months. We had big upward revisions to some of those months. Now you look and it's a mixed picture, but it's not that extraordinary weakness that at the time we thought was in the data.
It was really the justification for starting off that 50 basis point rate cut. And I don't know how they would have approached that meeting if it was different. I would say because they continued to cut in the November and December meetings, they don't regret it. But I think things would have totally changed if those 3 months of data were a little bit stronger as of the September meeting.
You're not the only one to say that. Jay Powell, when asked, said we might not have cut 50 had we seen the next employment report.
Right.
Which is funny because they really went 50 because they didn't cut at the previous meeting and they had gotten those weak employment reports in the interim between those 2 meetings. When you're data dependent and revisions are quite frequent, it shifts your expectations even in hindsight.
Absolutely.
It really shows the importance of data accuracy, not only measuring things, but getting them right. And, we had a pretty poor streak for data revisions this year. And in fact, that's something we've been talking about for a while in the markets. The reliability of the data just isn't what it used to be, partly because survey response rates are way down.
I think that's a really important point. So my last question for the trivia round, other than Jerome Powell, who is the longest serving current Fed governor? Governor, not regional Fed president.
There's been so
Barr,
much turnover. I think it might be Barr.
I'll give one hint, and maybe this will give it away, but think that the governors are appointed by presidents. And so if this is the Biden term, and before that was Trump 1, what might that tell us about the longest serving Fed governor?
Appointed by Trump or someone before Trump, I would think, is where you're going with that. So I guess we can safely say
Waller?
It's not one of the... Could be
When
Waller.
was Waller appointed?
He was appointed by Trump.
Was he?
Yeah, because, when they were speculating about who Trump might replace Powell with, Waller's name came up as the other Trump appointee, And I remember reading that and thinking, well, gee, if he wants a governor who's going to lower rates when they shouldn't lower rates, probably don't pick Waller because he's been on the hawkish side more often than not. So, yeah, let's go with that. Do you think?
So I have the historical list of Fed governors in front of me. Actually, I needed to double check this. So Waller was appointed December 18th, 2020, just at the end of Trump's term. But actually, November 26th of 2018, Mickey Bowman was appointed.
Oh,
There you go.
there you go.
Well, and there's another
wait,
one who's not going to cut rates if it's not warranted.
Going through my trivia research, one takeaway that I have is that last year we had things like a debt ceiling showdown and a few regional bank failures, all that stuff. And of course, this year was busy and volatile in a lot of ways, especially in the political sphere. But I think compared to last year, 2023 is the Fed going to keep hiking, right? As of October, November of last year, we weren't sure if the Fed was going to have additional rate hikes. And then 2024 was mostly about, well, the economy is in better balance, but it's just the fine tuning. So I think that is good for the prospects of achieving a soft landing, but it is not good for the prospects of good trivia for this episode.
Well, I appreciate
Well, I
that
think
out.
since we did a little bit better than last year, I'm taking it as a win. But we did set a pretty low bar last year, so fingers crossed next year we get even more.
I'm taking it as a victory too, as a quiz master, but something I will give you credit for last year was that one question I had about the Swedish central bank talking about Taylor Swift was included earlier in the episode because, Sophia, you brought it up as something that sums up 2023, which is a great segue into the next segment, which is what is one thing you think sums up 2024 in the macroeconomy in financial markets? Chris, what is one thing you think just says that is so 2024?
Probably the fact that we've been seeing longer term interest rates pushing higher, even as short term rates go down. And as a result, after a record long period of curve inversion, the yield curve is no longer inverted. I think that is so 2024.
I want to share my thing that sums up 2024 because it's very similar, which is that the sum rule was triggered, but the economy was still not in a recession. So we've seen so many historical regularities that have broken down this cycle. Some of that speaks to data reliability, but something like the inverted yield curve, right? The yield curve was inverted for about a year, and we still never got that recession. And so to me, the fact that the unemployment rate has gone up as much as it has without that negative feedback loop of layoffs and lower consumer spending is just a microcosm of how the economy has been able to come into better balance this year without a downturn so far, knock on wood.
Yeah. Oh, I would just add that, when you think about why an inverted curve leads to a recession, the curve inverts because the Fed has set rates higher than the market did. Fed controls short-term rates, market controls long-term rates. And normally, when that happens, the Fed is wrong, and you end up with a recession. They set rates too high. This time, the market was wrong. And I think it reflects the fact that we have come out of this extraordinary period of very low interest rates, and we're not going back to those pre-pandemic interest rate levels. Took a while for the market to figure that out.
Sophia, what is your indicator that you think sums up 2024?
Well, even though Taylor Swift was still on tour this year, she was not, in my opinion, the story of 2024. Mine's a little bit more sort of macro and to some extent esoteric, but I think 2024 to me could be summed up as the difference between economic data and the vibes economy, right? We had actually a pretty good year economically. I mean, you had Jay Powell yesterday talk about how he feels like the economy is honestly in a pretty great place heading into 2025. We had strong GDP growth. Yes, we had a little bit of a rise in the unemployment rate, but it's still relatively low historically. Real earnings are up. Inflation has improved from where it was. But yet, a lot of people don't feel good about the economy this year. And that was something that was very evident in polling, very evident in, the way people thought about the economy going into the election. And I think a lot of the difference in the vibes and the data comes down in part to what we talked about earlier in terms of housing, but also around the difference between, and Powell also touched on this yesterday, inflation, which when we talk about that, we're really talking about the annual change in prices, and a higher price level, right? Which is kind of the cumulative effect of inflation over the last 4 or 5 years. That is what people are really feeling. Grocery prices that are up, 30% from where they were in 2019, even though if we look at food inflation versus 2024 or 2023, we've seen a ton of improvement. And I think that that's going to be something, it was reflected a lot in the way people voted, I think, as well. That's going to sum up 2024, this sort of difference between we as economists, what the Fed looks at in terms of hard economic data that was pretty good, and yet how people didn't feel great about the economy in 2024.
I think that is a great point. And that difference between price changes and price levels, whenever I give a presentation, or not whenever, but most of the time, when I tell people the Fed is really happy with the rate of inflation right now, I have to remind them of that difference. I also think, this is a longer term project for economists to relate to the public better. But, in textbook models, economists have always thought if your wages double and prices double, your standard of living hasn't changed. It's not how people feel the change in their standard of living. So there is really this disconnect between how economists view the harm of inflation and how people perceive it in their standard of living.
We look at a basket of goods on average, but depending on who you are, depending on what income level you are, shifts in the prices of certain things relative to other things makes an enormous difference, right? So one that I get asked a lot about is auto insurance and household insurance. And so both of those are up a ton from year over year, but also since 2019. And that makes a huge difference than if, your discretionary spend is up a little bit as well. And so I think it's been a really interesting reflection, and you make a great point, Will, that economists could probably spend a little bit more time and be a little bit more sensitive to thinking about how everyone's basket of goods varies and how do we account for those changes as well when we think about inflation and price changes.
It was a huge aspect in the election. We know that from the polling going in and the exit polls coming out. It's not just what happened with inflation that affected the vibes, the way people felt, but also the sort of dark side of the immigration story. Fed loved immigration because it pushed the unemployment rate higher and limited wage growth. But those who were working, particularly in entry-level jobs at the bottom of the income spectrum, their wage growth slowed the most because those unskilled jobs were the ones that saw the most competition from immigration. When you look at the household survey results over the course of the year, too, domestically born employment actually fell last year, while total employment was up because of the number of immigrants who were hired. So I think within the numbers, you see that some people were considerably better off. And that's true from an inflation standpoint and an income standpoint. But there were some people who did not share in that improvement.
And I think that speaks to, the Fed and other central bankers often talk about how monetary policy is a blunt instrument. So they set policy and that affects the whole economy, and they have to look at the macro data, the national data. So they can't, lower interest rates for one region of the country that's struggling and raise them for one region that's overheating. And that just means everyone experiences the macroeconomy a little bit differently, even though the Fed has to react to the big picture. I think so far we've talked a lot about how our perspective has changed over the last 12 months, since we recorded the last episode. But for the next question, I want to ask everyone, what is the one thing that surprised you the most in 2024? And I'm going to start with this question, and I'm going to say the Fed's 50 basis point September cut. This still keeps me up at night a little bit. I really didn't think that they were going to go 50 basis points to start the easing cycle. It was so close to the election. Markets had gone into the pre-meeting communications blackout with 50-50 odds. There wasn't even all that much urgency, I thought, to go 50 basis points to start out. But it really shows that Chair Powell is pretty effective at exercising his power of persuasion when he really wants to. And it's something that I mentioned earlier is they probably don't regret making that decision because they continued to cut in November and December. At least one way to think about whether they wish they had only gone 25 that meeting. So I still think that this is one of the most surprising things I have seen in the 10 years that I've been following the Fed and the macroeconomy, is that the Fed decided to go with a 50 basis point cut in September.
Well, that was mine. You stole it.
That's why I went first.
100% agree. It haunts me because I was 100% in the 25 basis point camp. I was shookest when the decision was made. I had been on the road the week before and told people, oh yeah, I think they're going to go 25. I don't think they have 50 in them. I really was absolutely taken by surprise, and I hate being wrong, which is a tough thing to feel when you're an economist because there's a lot of times we miss things. But yeah, I was equally, totally surprised by that. I, in part, didn't think that they had it in them to start with 50 basis points. So I completely agree with what you said, and it will also probably keep me up a little bit longer. But I'm glad so far the last two meetings got it right, 25.
And I have to add to that, the days before that Wednesday meeting, the only things that led people to think 50 basis points was possible was a Wall Street Journal article that wasn't really even saying they were leaning towards 50 basis points. It was just saying the Fed isn't sure what they should do. Didn't look like there was any sort of inside scoop. And then the second thing was that Fed funds futures just started pricing in a good possibility of it, even though only days before they were pretty set on 25 basis points. So I have to reinforce the idea that really took me by surprise.
The Powell Fed has a reputation already for being beholden to the markets, to the point where Bill Dudley, the former New York Fed president, wrote about it in his column this summer, saying if traders really want a half-point cut, all they have to do is push for it, and the Powell Fed will capitulate. When they actually did it, they actually capitulated. I was shocked by it, too. I do think now, in hindsight, there might be some regret at the Fed, but I think you're right. Will, the fact they've kept easing since then suggests that the majority think it was the right move.
Chris, do you have a most surprising thing in 2024, or are you going to complete the Triple Crown and all three of us thought of the same thing?
No, I'm going to go with the strength of consumer spending. We did have a higher GDP forecast than just about everybody else at the beginning of the year, but a big part of that was built on expectations of much stronger business investment because of the industrial policy in the budget that encouraged plant and equipment spending. We saw a little bit of that, but when you look at the GDP breakdown over the course of the year, especially after upward revisions to the third quarter, now above 3% growth thanks to another upward revision to consumption, consumers are not only the lion's share of GDP, which they always are, but consumer contributions to GDP growth are enormous in the last year. That much anticipated consumer spending slowdown in conjunction with the drop in confidence, it never happened this year.
And I think this speaks to what you brought up earlier, those benchmark revisions to the national accounts, because so much of the idea of a consumer slowdown was premised on this idea of a loss of excess savings from the pandemic that suddenly now...
Yeah, and lack of income growth, exactly.
Right. It turns out consumers have a pretty decent savings rate and now can use income growth instead of savings to fuel more consumption. Well, it totally changes the picture.
I have to give some credit to our wonderful analyst, Mark, who made a great point to me this week, that some of that consumption growth also probably comes back to the increase that we saw in the foreign-born workforce and in just in general to our population, right? We actually had more people in the economy spending as well as the result of increases in foreign-born workforce in 23 and 24.
Yeah, and I think that ties into, reconciling the difference between GDP and GDI is when income was revised upward, that seemed to be an acknowledgement of more foreign-born workers in the country. Well, that means there's a lot more money to spend.
And you also have to credit lower inflation for part of it too.
Right.
Because when you look at consumer spending growth, nominal consumer spending growth has been slowing for a year and a half. It's real consumer spending is accelerating, and that's explained, of course, the difference between the two, lower inflation.
For the last segment now, to kind of wrap things up, I want everyone to share a 2025 indicator they think is important to watch, something that'll really determine the economy and bond market next year. What do you have your eye on? Sophia, why don't you start us out?
Oh, Will, I'm actually going to kind of steal yours from last year. The foreign-born workforce, and more specifically just the civilian labor force, is, I think, going to be critically important in 2025, in large part because there are potential big changes to our immigration policies and potential immigration reform coming with the new administration, which, as Chair Powell said, right, the Fed can do the arithmetic and less people might mean less work. And so I think that that's going to be incredibly critical to watch in 2025. Chris just put out his latest forecast grid, and you can see it very evidently, some of the assumptions we've made with the unemployment rate coming down and what that means for the Fed pausing in the middle of next year with rate cuts. And so I really do think that that's going to be, similarly to how important it was this year, even more important potentially next year.
I think that's right. And Chris, you were very spot on your forecast write-up that this is something that I think a lot of market participants are underappreciating is just how much those labor force dynamics are going to drive changes in inflation growth and how the Fed reacts to it. So Chris, what is your 2025 indicator to watch?
I think another really important one to watch is the Fed's long run Fed funds forecast, which is effectively, when you look at the dot plot, that's where the 19 FOMC participants believe the terminal rate is. That's where they're going to stop cutting. And the reason I think it's important is that when you look at the dot plot, considering the dot plot medians and the way they changed with this last Fed meeting, they're basically only looking for 2 rate cuts next year. The bulk of the FOMC is in 3 groups, expecting 1, 2, or 3. And then they've got 3 rate cuts after that in 26 and 27. So implied in that is a pause in 2025. I would just point out that in the past, when the Fed has paused, that's very often turned out to be the ultimate terminal rate or very close to it. They don't usually move very much from that point. So we'll see. Obviously, there's a lot of moving parts in the forecast. One, they're expecting, as I wrote in the outlook, that some of the inflationary forces likely with Trump's policies will be transitory. And that's a word the Fed is sort of banned from using after all their talk about transitory inflation in 21 and 22. But it does kind of look like the Fed is banking on some transitory inflation next year. And maybe that explains it, but I have a feeling that long run estimate is going to come higher. It's at 3% now. I think it more likely will be somewhere in the 3.5% to 4% range by the time it stops moving. That's sort of the basis for a much higher rate profile than we saw in the last cycle.
And Chris, we were talking about it earlier. There is such a wide dispersion of those longer run dots. I mean, at the one end, the dovish end, there seems to be someone on the FOMC who thinks that this post-pandemic economy is not all that different from the 10 years before the pandemic. And then at the other end, the hawkish end of that range, there seems to be someone on the FOMC who thinks there's maybe only one rate cut, I think, until you're at neutral policy. And those are two incredibly different realities. And of course, dispersion will narrow over time, but they're two different, really different ideas of the current stance of monetary policy.
Oh, that's absolutely right. I mean, part of it is the dispersion of the Fed's long run neutral models. One of them suggests we're almost there. Others, we've got a lot more room to go. But I think we're coming into this with a great deal of uncertainty. Powell described searching for the long run neutral as similar to walking into a dark room crowded with furniture. You move slowly so you don't hurt yourself. The one thing we know for sure, he said, is we're 100 basis points closer to it now than we were when we started cutting rates. And the implication is it's time to start moving more slowly even than we did at the last two meetings. So in other words, rather than cutting a quarter point at every meeting, maybe it's time to start cutting less frequently.
For my 2025 indicator to watch, it is Medicare spending. So I think that the focus next year, we're starting to have this quote unquote adult conversation about the deficit. And I think the trajectory is very concerning, and this will weigh on investors from higher treasury supply. And so if the Department of Government Efficiency, DOGE, or any of the incoming politicians are able to get the budget under control, I think Medicare spending is a microcosm of both the challenges and possibilities for where we could really get the deficit more under control. So in terms of the challenges, demographics are very difficult because we have more people retiring, and so that means higher expenditures for something like Medicare. But also, that demographic is a very reliable voting bloc, which is something that has kept Social Security and Medicare from seeing, I think, more significant cuts over the years. This is also the second biggest expenditure in the budget after Social Security. So if we're going to make a really big dent in the budget, cutting funding from PBS sounds like it's a really popular thing, and it plays into some culture war stuff or whatever, but it's not going to be what solves the budget deficit. I think getting something like Medicare spending will actually make a big impact because it's the second biggest expenditure. I think there's also a lot of room for improved efficiency. So a big element that the Government Accountability Office has identified in Medicare spending is a big amount of fraud. And so maybe artificial intelligence will be able to spot that out. Maybe changes in bureaucratic efficiency will be able to cut it. But Medicare is a place where this can happen because we can deliver the same services for less money, especially because the federal government has so much bargaining power as such a big buyer of healthcare services that they could negotiate lower prices. So to me, I'm very interested to see any changes in the dynamics of Medicare spending next year as it applies to the federal deficit.
Yeah, that's a really good point. There was a terrific article recently in the Wall Street Journal just contrasting the general rise in inflation against the rise in medical care services. Medicine is extraordinarily expensive. I think people are becoming extremely frustrated with the way our medical insurance system works, especially how much medical insurance adds to cost without increasing the quantity of medical services people get in exchange. It may be that we're actually on the cusp, among other things, of another government reform to the way we pay for medicine. Because, as you said, there's a ton of fraud, but there's also less and less coverage despite more and more spending.
So that is our wrap up of the 2024 year in review episode. I want to thank Chris and Sophia for coming back. And as if this were one of our webinars, I will also give both of you an opportunity to say any closing words to our audience as we look to 2025 for a prosperous and healthy new year. Chris, why don't you start us off?
Well, I think it's going to be a really interesting year. The fight we just saw over the budget continuing resolution points to another potential use for AI, and that is Congress can't necessarily hide things in 1,500-page bills anymore. There may be some new responsibility in government and spending in the year ahead, and ultimately, that's a productivity enhancer too, so something to celebrate.
Sophia, any parting words for saying goodbye to 2024?
Well, first of all, Will, thanks so much for having us back. It's great to recap the year. It always feels like not a lot has happened, and then we have these discussions, and it's like, wow, it was a busy year. 2024, a lot of it has been wait and see, right? We're waiting to see when the Fed would finally start easing. We were all waiting to see what would happen in the November elections. And with 2025, I think we have some answers. There are still a lot of questions, and I think there's going to be a lot of shifting developments. So as Chris said, it is teeing up to be another interesting year, definitely going to be a data-dependent one for the Fed as well as they move forward. And so I'm excited to see what will happen, and I wish everyone a very healthy and prosperous new year as we head into 2025.
Chris?
I was going to say you're so right, Sophia, that, who would have even remembered the CrowdStrike story if you hadn't brought it up? Well, I had a daughter who was supposed to fly on that day, and of course, all the planes were grounded for a week. And yet, here we are at the end of the year, and that turned out to be one of the smaller stories of 24. It really was a remarkable year. So thanks for the opportunity to remember all this stuff.
And I want to thank all of our podcast listeners. It's been another great year of Simply Put. And for 2025 and onward, if you have any guests or topics that you'd like to see on the podcast, you can email simplyput@fhnfinancial.com. But thanks to everyone for listening, and we will see you in 2025. That was Chris Lowe and Sophia Kearney-Lederman. This was the second time we've done a year in review episode, and I think that just like last year, running through everything that happens over the course of 12 months really helps illustrate how much the narrative can change over a short period of time. Markets started the year confident the Fed was going to start rate cuts at the March meeting, but easing didn't start until September. If you can believe it, one Fed official was expressing some concern that inflation might get too low after a few months of ultra-cool data this summer. Now that we're at the end of the year, the economy appears to be at no risk of a downturn, and inflation is steady at just over 3%. In a few months, either one of those macro indicators could be trending in a totally different direction. The data calendar picks up a bit next week with the ISM manufacturing for December on Friday. Light trading during the holiday week could leave Treasury yields susceptible to some aimless drift, especially with investors executing month-end and year-end trades. Once traders return to their desks more completely the following week, the November jolts and December ISM services will set the tone before the ADP employment release on Wednesday, January 8th. The most important data over the next 2 weeks will be the December non-farm payrolls on January 10th. The consensus expects the unemployment rate to stay unchanged at 4.2% and for job growth to continue decelerating after November's rebound from the weather-impacted number in October. Also on January 8th, the minutes from the Fed's December meeting will be released. We know 4 Fed officials favored keeping rates unchanged at this meeting, so the minutes may shed light on how deliberations within the FOMC are looking as some participants express their opinion that policy is close to or already at neutral. That's all for today's episode. Thanks again for listening. I'm Will Compernell, macro strategist with FHN Financial. This episode was edited by Bill Stanfield. Don't forget to like and subscribe to Simply Put wherever you get your podcasts. Email simplyput@fhnfinancial.com with any questions or comments. This podcast is presented for informational purposes only and is not intended as an offer or solicitation with respect to the purchase or sale of any security. Views expressed herein accurately reflect the speaker's personal views about the data, news, trends, events, etc., discussed herein or any subject securities or issuers. No part of their compensation was, is, or will be, directly or indirectly, related to any specific recommendations or views expressed. FHN Financial, through First Horizon Bank or its affiliates, offers investment products and services. Investment products are not FDIC insured, have no bank guarantee, and may lose value.